I'm sure you're all familiar with the state of the real estate market. Ever since the pandemic hit and interest rates went to zero, real estate prices and rent have gone to the moon. The average US house has increased 50% in price from $322,000 to $480,000. And the average rent payment index has rocketed from 340 to 413, and that's just the average. If you look at certain cities like Austin, Texas, you'll see that housing has doubled and even tripled. More recently, prices have cooled down a little, but prices are still way higher than they were just a few years ago. While this has sucked for new home buyers, it's been a blessing for homeowners, real estate agents, and everyone else that's profiting from the real estate market. And what bigger name is there in real estate than Zillow? They've been the go-to marketplace for buyers, sellers, renters, and landlords. Even if you're using a real estate agent, it's more than likely that you're using Zillow as well. So you would think that Zillow has been pulling in the big bucks like Google or Facebook, but it's actually quite the opposite. In fact, Zillow has been consistently burning money throughout this entire real estate boom. The worst of it was actually during the peak of the market. Zillow's revenue isn't doing much better either, which has fallen over 50% since 2021. Hearing this, I don't think you'd be surprised to hear that their stock is down 76%. But what even happened? Why is Zillow doing so poorly in the hottest market in history? Well, part of it is just because Zillow has the Silicon Valley mindset of growth over everything. But the bigger part of it is actually some good old karma. You see, after seeing all these investment and private equity firms enter the single-family market and making a killing, Zillow decided that they wanted to do the same thing. And let's just say, they borrowed a lot of money and bought the top, and they've been desperately trying to exit the business ever since. So here's the story of how Zillow tried to screw over homebuyers and ended up getting screwed over themselves. If you're interested in deeper dives, interviews with insiders, and exclusive tech analysis, consider subscribing to our free weekly newsletter. Taking a look back, the story of Zillow's troubles dates back to early 2018 when Zillow's CEO-founder Richard Barton announced that Zillow would enter the lucrative house flipping business. Fun fact, Richard was also the founder of Expedia and Glassdoor, but anyway, the idea was pretty simple. Zillow had been collecting data on the real estate market since 2006, and they had built up likely the most comprehensive real estate database on the planet. So they had more data than anyone regarding which markets were hot, what type of sellers sold for the least, what type of buyers bought for the most, and so on. They also had the luxury of promoting their flips all over Zillow to potential homebuyers completely for free. So it seemed like a brilliant strategy to use their wealth of data and resources to profit big. From the very beginning though, investors were quite skeptical about the idea, largely due to one reason: how much would it cost? Whether you're an individual or a massive corporation, buying real estate on the scale that you would like is an expensive undertaking that generally requires a lot of debt and interest. Moreover, the house flipping business is a low-margin business. You only hear about the big numbers during euphoric periods in the market where you can buy high and sell even higher. For the most part though, you won't be seeing margins higher than 10 to 20%. That probably doesn't sound that bad, but you have to compare it to what Zillow already had going. While Zillow wasn't profitable, their gross margin on the revenue that they did pull in was a whopping 92%. And the best part was that as a software and ad business, they could scale to infinity for extremely cheap. With the house flipping business though, cost was directly proportional to profit. To make more money, you have to invest more money. There's simply no way around it. And that brings us to the next red flag, which is how Zillow was gonna fund this massive operation. It's not like Zillow was sitting on $60 billion worth of cash like Apple and was able to casually bet $5 or $10 billion on a house flipping business. No, Zillow was already a money-burning business, meaning that this entire operation had to be funded using investor money and debt. Some foreshadowing, Zillow's debt would 6x in the coming years from a few hundred million to nearly $2 billion. Zillow investors realized all of this the day that Zillow announced this plan. That's why Zillow shares fell 9% that day. But despite the initial hesitations, Zillow would move forward with their house flipping business, and investors would soon come around. Not because the idea was suddenly good, but because of FOMO, or the fear of missing out. You see, it wasn't just Zillow that was embarking on this grand vision of pumping up and trading the real estate market. Redfin had their own version of Zillow Offers called Redfin Now. And let's not forget about Opendoor and OfferPad, who were building entire businesses around this model. So if anything, Zillow was actually late to this trend. So despite the initial concerns, investors would give Zillow a good amount of slack to pursue this idea. And with that, Zillow would launch in the Phoenix and the Las Vegas markets. Zillow Offers actually started off relatively well. In fact, many homeowners really liked the program as it largely simplified the process of selling your home. Homeowners didn't have to deal with real estate agents and open houses and negotiations with buyers or any of that. All they had to do was fill out a simple questionnaire on Zillow and upload some photos of their house. From there, Zillow would get back to them with a cash offer within just 48 hours based on the Zestimate for the house. If you were willing to move forward, Zillow would send an inspector to your home to identify repairs and damages. This amount would be deducted from Zillow's initial offer, but that's pretty much it. If you are happy with the offer, you can sign all the paperwork online, choose a closing date within the next 90 days, and walk away with no hassle. This was honestly an extremely innovative and modern way to sell a house, and it's no wonder why sellers loved the program. We should also mention that the process was not only convenient, but oftentimes there was no convenience fee. Whether it's Uber Eats, Instacart, or instant bank transfers, you often have to pay a substantial fee for the convenience, but that wasn't the case with the Zillow Offers. Now, technically, they did have a fee as high as 19%, but Zillow Offers were often so out of touch that even with the fee, it was extremely competitive or even over market value. In fact, it was alarmingly common to hear about Zillow Offers being $50,000 to $100,000 above market value. Now, Zillow would sometimes realize this before closing and they would rescind their offer out of the blue, but more times than not, they went through with these silly offers. Why, you ask? Well, that comes down to the biggest shortfall with this entire model, which is that the real estate market is not homogeneous. Zillow wasn't using local experts to value and make offers on these homes. Instead, they were largely relying on sales data and their algorithms. And while that's a great start, the reality is that real estate is a lot more qualitative. Just because two homes have the same square footage, the same number of bedrooms, and are located on the same street does not mean that they'll sell for the same price. Buyers may like the trees or the floor plan or the neighbors or the lawn of one property way more than the other. And the only way to account for all these individual differences is consulting with a local real estate agent who's familiar with what buyers are looking for in the area. Since Zillow was largely just relying on the data though, their offers were usually off the mark. They would usually come in a good amount below market value or a good amount above market value. And here's the thing. Everyone who got a below market offer is going to be extremely unlikely to move forward, while everyone who got an above market offer is going to be extremely likely to move forward. And when you zoom out, you end up with a situation where Zillow is consistently buying houses at market value or above market value, something that is disastrous for flipping houses. Zillow was literally underwater before the flip even began, and this trend simply went into overdrive during the pandemic. Heading into the pandemic, Zillow would expand its offers program across the nation to dozens of cities, which put them in the perfect position to get annihilated. And just think about it. What happens when you're consistently making above market offers and the real estate market skyrockets? Well, you're gonna be consistently buying the top. Now, this can work for a short period of time, as you should be able to buy high and sell even higher, but eventually the music stops playing and you end up with 18,000 homes that you bought at the absolute top. This is precisely what happened to Zillow, and that became extremely evident by the end of 2021. And on November 2nd, 2021, Zillow would officially announce that they were exiting the home flipping business. The damage? Well, Zillow had lost $881 million in 2021 alone, and the people that were going to pay for it were the 25% of Zillow staff that were let go. Since then, Zillow has been vigorously offloading their stockpile of single-family houses, selling thousands of houses at a time to other corporations. Exiting the house flipping business has allowed Zillow's gross margins to recover back over 80%, and their excessive quarterly losses have also cooled down. But the same cannot be said about their debt. While their debt has come down from $1.6 billion to $1 billion, it's still triple where it was before this whole ordeal started. So there's no question that Zillow will be paying for this mistake for years to come. Since then, Redfin has also shut down their house flipping business, and as for Opendoor, well, they currently have a bankruptcy probability of over 100%. So I think it's safe to say that this whole experiment of corporations flipping houses and further manipulating the housing market was a big bust. With all that being said though, there is some merit to this whole idea. The idea that you can use data and algorithms and AI to essentially trade the real estate market. After all, that's exactly what hedge funds and quant firms do with the stock market and futures market on a daily basis. But the real estate isn't quite the same thing. When you factor in local preferences and especially the emotion associated with buying and selling a home, it's very hard to gain an edge with just quantitative measures. Warren Buffett, the legendary stock investor, is well aware of this, and that's why he doesn't get too involved with single-family homes even though he loves the market. He says, quote, "I'd buy up a couple 100,000 single-family homes if I could." And that is the key. If he could. Warren Buffett knows that he can't. Zillow, Redfin, and Opendoor thought that they could, but clearly they couldn't. This isn't to say that such businesses will never be successful. Maybe with a touch of AI and maybe even a human touch, it could be viable. But just because it can be done doesn't mean that it should be done, as it would simply further screw up the housing market. For starters, it would simply take money away from the local home flippers and the local real estate agents and put it in the pockets of some multi-decade billion-dollar company and its shareholders. Also, who knows how this level of corporate involvement would affect pricing power and pricing manipulation across the housing market? Personally, I don't want to find out, and that's why it's a good thing that when Zillow tried to screw over homebuyers, they got screwed themselves. If you're interested in having companies pay you, check out our bond investing app Silo in the description below. But until then, I'm Hari, and I'll see you guys on the next one.